I think in the over 2 decades we've worked together, Matt, we've dealt with our fair share of uncertainties. You might even say that uncertainty is just a constant in our markets. But it seems like today we're in an environment where the uncertainty meter is even higher. We're 2 years into a pandemic. Russia has recently invaded Ukraine, and we're seeing inflation at levels that we haven't seen in 4 decades. How is an investor supposed to make sense of all of this?
We've seen a sharp increase in U.S. and global interest rates, both in emerging markets in 2021, in developed market countries in 2022. When we look at non-treasury spread sectors, we've also seen a moderate widening in credit spreads, and to us that looks attractive. So we can generate a little bit more income on the duration portion, and we can also generate a little bit more income with wider spreads in the credit portion, assuming that we're comfortable with the credit risk that comes with that type of volatility.
Usually wider spreads come with increased default risk. We actually think that in this case, that's not going to happen. Only 2 years ago, we went through a down cycle. We had a lot of companies restructure, and not just due to COVID. So while there might be some volatility in the short run, given the macro themes that you've hit on, Matt, we don't expect much in the way of losses or defaults over the next few years, which makes today a pretty attractive entry point for high yield credit.
For our clients, we think it's an attractive opportunity to generate more income, both on the duration portion and the credit side, without a lot of future defaults priced in.
You know, Matt, when you're looking at shorter term performance, what happens over the next 3 to 6 months? Yield doesn't tell you a whole lot. There are times when yields have been high and you have poor returns. There are times when yields have been low and you have good returns. But when you look at yield versus a little bit longer time frame, maybe around 5 years, there seems to be a much higher correlation. Can you expand upon that?
Yield to worst is a very strong, reliable predictor of what future returns will be for investors if they hold an investment to maturity or over a 4 to 5 year time period. If you look at the yield to worst for the high yield index and go back to arguably one of the most challenged or worst times to be an investor in high yield, if you bought high yield back in May of 2007, the yield curve was slightly inverted, credit spreads were close to all-time tights, and the yield to worst in the high yield index was 7.3% back in May of 2007. If you held on to that investment for the next 4 to 5 years throughout the global financial crisis, that investor would have earned over the next 5 years on an annualized basis 7.7%. So slightly more than the yield to worst that you started with. And that's arguably the worst time to be a high yield investor, and still you generate really healthy returns.
The problem with owning the riskier part of the high yield markets is that it can be very volatile, and that unnerves some investors. You and I have been big proponents over the past couple of decades working together of what's known as a barbell approach, mixing in some of that very high volatile spread sectors, high yield emerging markets, with interest rate duration, US treasuries and other government securities. Is that a style that should still work in today's environment?
It's worked for the last 20 years. We have high conviction that strategy should work very well in the future. Correlations between high yield and US treasuries have turned modestly positive. We would expect that to revert to more normal low to negative correlation in the future. The beauty of adding treasuries is you build a portfolio that's very liquid, you can minimize some of the drawdowns, and you can take advantage by rebalancing into cheaper spread sectors when capital market stress hits. The beauty of owning US treasuries is a balanced approach, is the US Treasury yield curve is relatively flat. And normally what happens after you have a flat US yield curve environment is that US Treasuries generate strong absolute returns as growth eventually begins to slow.
I think that's a really important point, because as yields have been low for most of the past 15 years, we have seen on average curves be steeper, and you've gotten a lot of roll down, right? Roll down being longer bonds just with the passage of time become shorter bonds and trade at lower yields. That's not going to be there as much today, so you're going to need more returns from the absolute yield component of the Treasury.
But when we look at the Treasury market and what's priced in, we have a lot of rate hikes priced in the US Treasury yield curve over the next 12 to 18 months. If the Fed does not deliver as many rate hikes that are priced in, investors will likely be very happy that they own some portion of their funds in US Treasuries. So not only can you earn that attractive yield, we've seen a repricing in yield in the last 6 months, it acts as a good mitigant if credit spreads do widen more than we would expect from a base case point of view. When we look at American income, we can see that the yield to worst on offer is above 6%. Now, over the prior 15 years, that doesn't happen very often. There's only 2 specific time periods where the fund offered significantly more yield than that. The global financial crisis back in 2008, and the COVID crisis when it started back in March and April of 2020. This offers more yield today than on average over the prior 15 years. There's only about 10% of observations that offer more yield than 6% for American income.
Matt, that does sound like a really good entry point today for the fixed income investor that wants to be balanced. Ultimately, yield is what generates returns in fixed income. And yields are just a lot higher today across the board than they were just a few short months ago. And that means that investors are likely going to be rewarded for either holding or adding to their fixed income positions today.
投资一定有风险，基金投资有赚有赔。申购前应详阅投资人须知或公开说明书。